The original concept, Jim Bishop and I had the idea. Jim had the idea and I agreed with it, that we should create this guarantee agency in the basement of his house, and our two wives would actually be able to run it, and he and I would get wealthy. That was the plan. That was the entire business plan, 1976.
Yeah. Vi called and I said, I've got another project I need some help on. He said, well, what's the project? He said, well, there's a group here in Aberdeen that wants to get a student loan program going.
Then later we started Student Loan Finance Corporation, and he and I and Manley Feinstein were the original incorporators. That happened in December of 1978.
We would go into the money centers, borrow money by issuing bonds against our loans, buy loans from the lenders, and service them through payout.
My banking experience was telling me that this is not going to be simple.
And we went off to the market, and I think it was in the summer of 1979 that we had our first issue. I think it was like 52 million.
A big surprise to all of us. Had I been a drinking person, I'd have had a drink. A big part of our strategy was that we would buy any loan, any time, and any amount, any status. At the time we started the company in '78, there was about $14 million of annual volume in South Dakota. After 1 year of being in business, that volume was in excess of 25 million. After 4 years of business, that was almost at 89 million.
It seems to me that in the early 90s, that reserve had a balance of about $50 million, and by the time we got into the 97-98 period, that grew to over $70 million. And so here was a non-for-profit corporation in Aberdeen, South Dakota with an investment portfolio of over $70 million of securities.
So it was in 1997 when we could convert to for-profit that we could then be something other than acquiring student loan notes under the Higher Education Act.
And then they were going to convert it to an ESOP, and the employees were going to own the business.
So if we were actually going to dissolve the not-for-profit, what the Treasury said is this money has to go someplace other than into your pocket.
And that's when we set up the foundation for about $86 million.
It was in the 90s when we started that, when we started identifying that we needed to step outside and do the marketing bit.
The market was changing very rapidly.
What you see today is not what you'll see tomorrow, and it's not what you've seen last week. We're changing so fast, but it's good. It's a good, fast train to be part of.
In 2002, I took a break from SLFC.
2003, 4, pretty much the same. We were growing the company. We were working on we were doing the government program and our own private program. We were getting U.S. Bank more interested in what we were doing, and they were doing a lot more for U.S. Bank.
During that period of 2002 to 2005, we had hired a fella to my choice for running SLFC, who didn't work out very well.
Fear, we were scared. A lot of the people that had worked for student loans, of course, were frustrated and angry.
It was some troubling times where we went through the company being an ESOP company, and there were some frustrations on employees as they saw their stock values drop. It was challenging times.
So after this long successful run of raising money and then kind of playing an important role, remember, we wrote a check for about $90 million, $86 million to South Dakota to become a for-profit. And then having been kind of successful at creating this new IT infrastructure and attracting this business from U.S. Bank, and then the changes in the student loan industry, and then the changes in the economy, by 2006, quite frankly, we were almost bankrupt.
I chose at that time to come back to SLFC, and I thought I probably better take the responsibility to come back and see if we couldn't salvage what was left, which was not much. There had been a pretty devastating change during that 3-year period of time in cash and in the kind of the plan of the business.
You know, the thing that was with the servicers like student loan, that was a biggest fight, is that you had the government program and they were constantly putting in all these regulations and rules, and we were having to follow those regulations and rules. And so you're constantly changing your systems to try and accommodate the rules that they're setting up. And that's kind of where we ended with not doing the federal loans anymore, because they were getting so many rules and regulations in effect that we couldn't keep up. We couldn't, it didn't make sense. It was too costly for us to continue down that path. And that is kind of when they made the decision that they were going to get rid of our loans and have ACS service them.
When I came back in July of 2010, the company was in turmoil. We had a joint venture that wasn't working. We had a trustee that was uncooperative. We had a CPA firm from Minneapolis and Chicago. It was one of the larger firms in the country that they weren't performing, they weren't delivering. It was just, and then we had a lawsuit from the Department of Justice.
It was December of 2007 where we really started to see this stuff that's going on in the market is going to impact us. When
President Obama came in 2008, they had a provision in there to terminate the public-private partnership of the FELP program, and so that really obviously dramatically changed the way SLFC was doing our business.
When in 2008 the market crash ended secondary markets. So we were trying to pull out of one bad deal when we got hit with a worse deal, which was no business model at all.
The fact that we couldn't finance loans anymore really put our business at a standstill. The warehouse that we had, the warehouse funding that we had from Citibank, they went from, we're put as many loans in here as you can, we're gonna securitize this, take it out and do it all over again. We're gonna grow your company. They went from that to, you guys are in default, you don't get another dime from us, you gotta pay us back. All of that happened within the course of about a month or two.
30 years of business where simply the model was if you paid premiums to your lenders who were doing all of the marketing for us and the guarantee agencies who were marketing to the schools, the secondary markets had a relatively simple model, and it was you pay a premium to get the loans, you own the loans. That was so successful during the first 30 years of our business, and no one ever imagined that that could abruptly stop. There might be a wind down, which we expected with the student loan program going to the direct loan program, but nobody ever anticipated that there would be this abrupt stop.
If you layer on top of that the external, what was going on externally affecting this company, that's what I'm saying. That was sort of layered onto their workload, and it was a real challenge. There was the problems in the market, there were problems, the company had its own issues to deal with. I think that for 9 years, all the years I've been here, the company has worked hard to get out of some of the issues they've had to face.
The world, though, changed. The economics of that changed when the federal government, of course, kind of changed the structure of the industry, and we could no longer, it was no longer viable to be in the business of acquiring portfolios, let alone originating. So it became, very complicated for us because we had this great technology platform, and we had attracted $1 billion plus in business from U.S. Bank. We'd built all this, and then the economics in the industry shortly afterwards changed, which was tough for us because we had to figure out, well, what do we do?
The financial debacle of 2008 brought everybody down and has changed the financial markets going forward in extraordinary ways that we will never go back to. You see that in a lot of the ways that the banks are being regulated at this point. You see it in the unwillingness of banks to pretty much make any loans now, which is also a stalling function for the economy's growth and recovery in general. But kids are still needing to go to college. Kids are still borrowing more money.
I went to a school that's really high in academics as well as sports. So I mean, I thought I made the best decision. It was either that or going to like a junior college, and I wanted to, actually stay somewhere and get somewhere where I could get a really good degree and go somewhere. So, it was a little more expensive, but that's just the choice I had to make, I guess.
We're here to serve our communities and the surrounding folks that patronize our communities, and that's our mission.
That was probably the hardest part because, in the end, that's kind of what it comes down to. You can go anywhere and get a degree, but the paying for it part is definitely the hardest, and it kind of hurts because you want to go to the big schools, you want to go here, you want to go there and do things like that, but if you don't have the money, it's hard to do it, and you don't want to be stuck with bills your whole life. You want to, get a house and do all that stuff too.
They're not going to be a good customer of ours if all we do is take advantage of them and try to lend them as much money as we possibly can. It's more about having that student be able to come out of college and be able to afford what they've decided to do.
Right away, initially, I was like, you got to be kidding me, I never thought I'd make enough money to pay for that in a lifetime, those numbers are just way too big, and it's crazy.
You look into the future and you snap your finger and your kids are old enough to go to college, and you always meant to develop savings and all these things, and for the most part it didn't happen.
For athletics, I got a little bit less than half of it paid for. I have a couple of federal loans, and then which is still only gets me about halfway. Still only gets me about half, so it's kind of a bummer.
One of the things that I've felt is that if you're gonna create opportunities for the bank to bring in younger folks, first of all, your staff needs to look and feel young. Your product line needs to look and feel young. And I thought to myself, gosh, we need to develop a program somehow, some way.
In 2008, then, we were left with a company that was struggling to get back to normal, and normal ended. We had to come up with a brand new kind of a business concept. For the first time in our life, we had to become a marketing company because the capital sources were destroyed. So the plan was, let's start a private loan program, and we will use capital from private banks.
I got to know those folks through some of the trade associations, through ICBSD, Independent Community Bankers of South Dakota, and Independent Community Bankers of America.
So what happened is that we shifted focus, and what we did was we allied with the Community Banks Association, and we created an alliance, and we created some new technology, and that technology was iHELP.
The folks from Student Finance Corporation came and talked about this concept of providing gap financing for students to fund their education. And boy, I tell you what, that just triggered me. I thought, boy, that's a great idea, and maybe I can be part of that.
Now we had to go sell ourselves to lenders, the community banks, for our source of capital in order to originate and process the iHELP loan. We also had to market ourselves to the schools to be able to get on what is called the lender list. So we found ourselves in a brand new world of marketing and sales instead of financial services, with the very same people.
Because as I said, when haven't they been challenging times? I think when we first were starting, back in the 70s and 80s, back when SLFC was first formed, it was formed because of a need for additional capital for students to be able to go to college, because the banks, more students were going to college, more kids were borrowing more money to go to college, and the banks didn't want to hold on to that much paper.
It was so similar to 1978 in 2008. There was no doubt. There were times in 1978 when we were starting Student Loan Finance Corporation that we did not sleep wondering if we're going to make it the next day. 2008 was exactly the same position as we were in 78. We were a startup with 30 years of experience, and it was that, having that experience, I think, that gave us the courage to say we can do this again.
We rolled it out, and you know, it was slow to start. It was building a brand. I mean, we were competing against the Sallie Mae's, the Wells Fargo Discover, and here we are with this new little product that hasn't been known by anybody. SLFC was prominently known in the Midwest, but we were reaching out to 50 states, you know, with the community bank membership, and so that in itself was an obstacle. SLFC's never really had to market themselves, and so we found ourselves in a position where we had to start, how do we say we're good?
A massive amount of change in our culture because of the model we had was so well done, so simply done, and so fluid. To make that change took longer than we thought. We started in 2008. We had our first meetings of the iHELP group, and we had determined that we were probably not good enough at marketing. We're going to have to hire people to do this.
iHI's goal for what was successful for this group of partners, you know, was just getting traffic. You know, SLFC's goal was getting volume on the book, a lot of applications. Reliamax, who's the guarantor of the program, well, they would rather have a high dollar amount rather than many applications because they make money from that, their percentage on that. Well, and Kevin Moen's group was about getting into schools. And so where it all comes down to is that you've got all these partners that are part of this iHELP program.
And the other one was a company called Navigant, who is a mapping and mining company in the internet business, who can pull together information for high school students and their parents to be able to make what we call value proposition decisions.
You know, it's a partnership with the banks that are originating and then the banks that participate. And you have the Student Finance Corporation is an intermediary that facilitates all this, along with an insurer that helps insure these loans, which makes it a better product for all involved.
So that collectively was put together in November of 2008. We had our first meetings, and we spent the year 2009 in legal matters, documents, developing documents, and hired a law firm out of Washington, D.C. To do all the documentation for us, and finally launched the program in 2010.
I mean, we're not here just to give out loans. We're here to help kids. You know, we want to try to get every student out there that wants to go to college, because I saw a quote the other day. You know, there may be some student out there with a cure for cancer, and they might not afford to go to college. You know, we want to get that kid to college. We want to make sure that they can fulfill the dream they have of getting a higher education. Yeah, I think student loans in the last 10 years have been, almost students have been taken advantage of. And I think iHELP has some tools that help the student understand it better and makes their ability to plan better for the time when they're out of school.
And Navigent was able to pull information together that we called a product called Right Choice, where choices can be made about which school you're going to go to, what's your career, what's your path going to be, and if you take that path, understand what the return might be on that investment.
It's just a tool or resource for them to use to kind of put that roadmap in front of them to prepare them for school and prepare them find out what career they'd be interested in, find out what scholarships are available for the school that they're going to, so on and so forth. So it's an all-encompassing site that students can use, and it's proved to be very useful for them.
So in middle of 2012, we had to come in and cut our budget, cut all of our employees 20%. They didn't like it, but given the kind of people they are, they've stuck with it.
People use the terminology that it's a family, and it really is. There's stress and frustration, but ultimately, I don't know if I've ever seen a group of people that pitch in so much to get the job done the way they do here. And management, leadership acknowledges that, appreciates it.
Like I said, it's that whole ownership of it. I grew up there. I mean, I was 20 years old when I started there, and I'll be 50 this year. I mean, it's my baby. It's my company, as well as everybody else that works there.
We had the strength, the power of our people and our process. Was something we could stand on. We could absolutely understand and believe in the people in the process of SLFC to work through whatever strategy we had to develop to bring the company back. And they performed. They did it.
This last 3 years, I can count 3 or 4 times where we were right on the step of failure. And by the grace of God and hard work and some timely things, we got through it.
From 2002 to 2010, we were kind of this destroyed company, transforming company, and finally having something that looked like we have a business plan and we have a strategic plan that really does look like it can be competitive.
I think it means doing things that might be hard, might not be popular. I think there had to be some hard moves organizationally over the years, but it was all dedicated to the right thing, which was keeping the company going, keeping its place in the marketplace, living up to its commitment to its borrowing base. These are really important things that could easily be overlooked. And it's an important attribute.
And we finally closed the deal on the 9th of November in 2012. And that was a very important day for us because The trustee lawsuit went away. The DOJ settlement was paid, and all the bondholders were given new bonds, floating rate bonds. They got out of the auction rate, and we ended up with a above water financing again to move forward with that will pay us a return 10, 15 years down the road. So it was a big deal to get that done.
And finally, in 2013, we have seen the results of the iHELP program. And just yesterday, we dispersed 151 new loans to people that we've never seen, never heard of. They're in schools all over the country. They're using banks all over the country. This has been an eye-opener for a person like me who came from a total lack of computer savvy concepts to having our customers coming into this system, and we haven't had to do anything but show them the product, and they're willing to buy. Steve Colas had a conversation with a company in Washington, D.C. who was looking for a processor, a backroom operation, that could originate and service consolidated private loans, a concept that we had just been thinking about.
So I started taking a real keen interest in just really what was happening with private loans, what had happened with private loans, and kind of where do I think private loans are going, and reached some basic conclusions. Number one, private loans will make up an ever-increasing part of the overall student financing mix to go to attend higher ed.
On the other end of the spectrum in the private loan business, there are about $158 billion worth of business that are customers who have already borrowed private loans and are loans that are in repayment.
The conclusion is that there's an enormous opportunity, an enormous future in the student loan business for players that historically were in the government-related student loan business who kind of got hit between the eyes when the government said, hey, you no longer are playing here, and all of a sudden all of them started looking around for where is their place in life.
They've got a process that they can bring to this new company that on the front end were a lot of pre-qualification of the borrowers, which is going to make our jobs from the origination side much easier and simpler, from the servicing and collection side much easier. Where it's a game changer for us.
It's a symbiotic marriage, is the best way to describe it. You know, we're very, very good at identifying prospects and getting those prospects to receive, to take action on a marketing message. SLFC is very, very good at taking people that do respond to these offers and put them through the process and the mechanisms to be able to enter into a new loan, to pay off the other loans. You know, something as simple as paying off somebody else, believe me, there's an art to that in the student loan world, and these guys are extraordinarily good with that.
And they have just recently signed an agreement with us where they are going to partner with Student Loan Finance Corporation on licensing all of our operations from origination through payout and marketing that entire SLFC concept to consolidate private loans.
We talked about earlier where, for many years student loan just was in the industry, we were doing well, it was just a nice, easy road. We went through some hiccups, but now it's opened the eyes to there's other opportunities that we can explore that we really wouldn't have looked at before because we went through those challenges.
We can't go back to what we were before, but I do see the markets changing and maybe allowing us to do some of that again. But we've learned from it, and we've now diversified ourselves from some in learning to service for others, and we're constantly looking to take on new products, go different ways and continue to grow SLFC in different directions and not try and be on that same straight path that we were before.
The reality is the future is amazing. I mean, I told somebody that, this is kind of a little bit of a pun, but the future's so bright that I think I need to wear sunglasses. And, where is the future? The future is in helping parents, students, and institutions understand the significant and important role that private student loans can play, making sure that good product and fair product is brought to the people that will take advantage or utilize these loans.
Well, I think there's a couple lessons in here. One is persistence. Two is you got to keep your head up. You gotta see the forest, not the trees. And the other one is you got to take a risk. You got to step outside your comfort zone and do something that you may not be comfortable doing, or it hasn't been proved in the past. You just got to try it. And then having the good Lord upstairs watching out for you helps a lot.
I think SLFC is very well positioned with our expertise and our leadership, and especially with Norg's vision that we'll be having an important role to play in this business one way or the other, depending on whether it's opportunities we have to make or ones that might get opened up for us.
From 2002 until today, we have successfully transformed SLFC from a financial services institution into a successfully marketing and selling a product with a capital base that's private and totally private company. Kind of proud of it.